Welcome to Retirementals, a podcast that dives headfirst into the issues facing the financial sector at the intersection of investment, technology and financial advice. Hosted by Abraham Oksanya, you can expect raw honesty, critical analysis and energetic interviews. Here is your host, Abraham Oksanya.
Hello there. Welcome to Retirementals. I'm Abraham Oksanya, and it's my pleasure on the podcast today to welcome a guest, one of the big brains of the industry in terms of consultancy and digging into data of what's going on. I'm talking about none other than Heather Hopkins, the Managing Director of NextWealth. Heather, welcome to Retirementals.
Thank you. Thank you. To be called one of the big brains by you, Abraham, is a huge compliment. Thank you.
Oh, absolutely. Look, we're going to dive into a lot of the work that you've been doing, in the industry. But before we do that, do you want to give us a sort of a quick run through how you got into financial services and indeed, the UK? I know you're originally Canadian, so tell us a little bit about the journey.
Yeah, sure. So I should probably tell you how I came into financial services twice, because I left and I came back.
All right, who does that? It must be fun.
So I got into financial services. I think, like everybody else, I just sort of fell into it by accident. I was working for a political party in Canada, running the youth campaign for a national election, and I got really, really interested in polling, because I got to travel around the country with the leader of the party, who was doing, leader debates, all sorts of stuff. And I'd sit in these rooms with the pollsters, and there would be actual voters turning dials to say how they felt
Wow.
about the leader and what they were
Yeah.
saying, and then reading all the polling data and splicing that by different demographic groups. I got completely hooked on research and market research. And as was the way things were done at a certain time, I found a job in the classified section of a newspaper and applied, and I got it for a market research firm called Dalbar. It's a US company, but
Yeah.
I was in their Canadian office, and I started doing mystery shopping. Setting up fund accounts with banks and so on, and doing mystery shopping. And then I worked with them for 7 years in Toronto and Boston. And then when I moved to the UK, I didn't have any contacts. I didn't know anybody except for my husband, now then boyfriend, and found a job in an internet startup. And so I left financial services essentially, and I came back when I took over Platform. And it's a story I didn't really broadcast at the time, because it wouldn't have been helpful to my position then. But I didn't know what an investment platform was, and I was running a business called Platform. Completely bonkers, right? I thought a platform was a multi-sided marketplace with network effects, and it's completely the opposite in our industry, right? Like
Right.
it's completely different. So I came from this sort of internet startup back into financial services. But the reason I came back was because I was reminded, when I was talking to clients of Platform, how there's meaning in this industry, and I think we sometimes lose sight of that. But when I was working for the internet startups, essentially what we were doing was helping people flog more stuff to consumers, and they really are consumers. It's how do you get, what are they searching for on the internet, and how do we sell more, how do we optimize our digital marketing? And in financial services, there certainly is an aspect of that. I mean, you're trying to get people to invest more, but the purpose of trying to get people to engage and to invest is to give them a secure retirement and take away some of the stress that's caused from financial, sense of financial insecurity. And I was reminded how expert technically so many people are in this industry, and how much they care about what they're actually doing. So I was lured back. Can I tell you one more thing about that journey?
Please.
Not only did I not know what a platform was, I was essentially a stay-at-home mom. I was working 2 days a week for a firm, and then I took over as head of Platform, and it was such a break for me. I mean, I think they got lucky too, I will say that. But there's a lot of people who think that you can't take a career break. I took 7 years off, worked part-time, and then went from basically, stay-at-home mom, working, writing a couple of research reports for this firm called eConsultancy, to running Platform, new industry, completely new role. It was crazy, and I loved it. It was great.
Yeah, I mean it's incredible, and you did and still do a brilliant you did a brilliant job at Platform. What I found is, when people come into the industry, new people, as you say, come into the industry with fresh pairs of eyes. We've seen this with the work we do at Timeline and Betafolio. When we bring in a product manager who doesn't understand what a fund is or a platform is, he asks questions that many of us would think, as stupid. But actually, when you pause and you think, wow, why do we do it that way, right? So you did a brilliant job at Platform, and then of course you have the entrepreneurial itch, and you decided to scratch it with NextWealth. Tell us a little bit about that.
So yeah, I love. NextWealth's a great business, still is, but I didn't really fit in a big company. I'd never worked in a big company, um, and I always had wanted to start my own business. I'd started a business when I was in university, briefly organizing children's parties. I don't think I have the energy to do that anymore. But so there was the combined wanted to do it with a perspective. So my view was that looking at the industry, the retail wealth management industry, from the perspective of platforms was the wrong perspective. I
Mm.
wanted to look at the industry from the perspective of the financial advisors, rather than the sort of the custody platform on which assets are held. And I think there's just not enough information and insight about what's happening in the financial advisor market in terms of the tech that they're using, how they're running and structuring their businesses. And the thing that makes it fun as a market researcher is because there's not really great data on how many firms. I mean, nobody really even knows how many firms there are, right? We know how
Mm,
many
mm,
directly
mm, mm,
authorized
mm,
firms there
mm,
are,
mm.
but
Right.
we try and guess. We do a lot of work to try and estimate that, but there's just not much data. So it makes it fun as a market researcher because we can try and pull together different sources to draw a picture of what's happening in tech, in investment propositions, and in advisor businesses.
Yes, and you've done a lot of work on that around understanding advisor tech. You've done a lot of work on model portfolios, cost of advice. So kudos to you, and you have my immense respect for that. As you know, I have been critical of consultancy generally, and I think that you are on the good side of that, right? Which is why we're having this conversation, which is, you mentioned about looking at things from the advisor point of view. The problem, of course, is that a lot of the what you see with your previous employers and others is that they're looking at things from the provider point of view, and you have this convolution sometimes where they're writing reports public paid for by providers, and I'm thinking it's sitting here thinking, who really is the client? To me, the advisors are the product. The client is the provider, where they're marketing for the providers, essentially. How do you deal with that sort of thing? We know the challenge with doing research from the advisor point of view is that advisors don't want to pay for this stuff. They're small firms, they don't have the revenue to, maybe to pay for these sort of things. How do you deal with that potential conflict?
So I, I don't know we're better at it than our competitors, because I think they're really good, actually, and I have a huge amount of respect for what they do. Um, and everybody has conflicts, and it's just how you manage them. Um, in terms of what we do, so we do a maximum number of 5 sponsored reports a year. We don't write about the sponsor's business. We write about issues that are related, that we think are of use to financial advisors. So we do a piece of work on retirement advice for Aegon. It's not talking about Aegon's products, but it's a comprehensive survey of what's happening in the in terms of retirement advice, and how firms are approaching that. We've had some fantastic data on that to show the rise in use of modeling tools such as Timeline, which is fantastic to see over the course of that study. Um, but we try to do most of our work as market reports, so that we publish a report and multiple people can buy it. And then we give free copies to advisors, which is crazy, right? We had a consultant do work for us earlier last year, and she said, "You've got to stop selling to providers, you've got to sell to advisors." And I was like, "Well, it doesn't really work, unfortunately."
Yeah.
And the firms that would pay, the advice firms that would pay, are usually owned by providers anyway. So
Right.
so we do market reports where we do it once, sell it to multiple people, and then if we send a summary to people who are on our research panel. Shameless plug: if you want to be part of our research panel, just Google NextWealth panel, you'll find the link. And and you know so we'll give a free summary to advisors, and if they ask for the full copy, then we send it to them. And that's how we try to manage our conflicts. The other thing that we do is we do reports that aren't paid for. So we did a report in I think it was May 2020 on digital signatures. And so we got data from 23 platforms across 85 processes for each of those platforms to look at how are those platforms treating document submission. Do they need a paper form, scanned copy, digital signature, or just straight through process? Because as you remember, when you suddenly couldn't go and meet with clients and you needed a signature on form, you were a bit stuck. So we wanted to expose what was happening. And the problem I think that the financial advisor market faces is that these lone voices calling for change are just that. They're lone voices, and it's how do you aggregate those views? And that's what we see our role as, is trying to aggregate the views of this disparate, fragmented market to try and push for change that matters, rather than change that sometimes providers, they do it for the right reason. I think it's the thing that needs to be done, but it's not necessarily what advisors really need. So try to aggregate those views, if that makes sense. So anyway, long answer to say everybody has conflicts. We try our best to manage it. I think we've got it right most of the time. We say no to clients who want us to come out with a particular view, and we do get those, and we just say no. We have refused to renew people for market reports who put too much pressure on us. They think we're too critical of them. We won't take their business. Not great from a business perspective, but I can sleep at night.
I mean, don't get me wrong. I'm not asking anyone to work for free, right? I think that the consultancy model has, as a challenge that advisors had pre-RDR, to try and figure out a commercial model that works, that's sustainable, that's scalable. I think it's a little bit of a challenge. But anyway, that's not to say that good work isn't being done. Indeed, you've done a great piece of work that I want us to dive into. So congrats on your report on model portfolio service, particularly in sizing up the market, right? I did a tweet a while ago when I looked at 3 consultancy, yours excluded, and I looked at how much they said the model portfolio market was. One said it was 40 to 60 million. The other said it was I think there was one that said it was 150 million. And you could drive a truck through that gap. And we've done some work internally, just thinking about this. And so when I saw your report, maybe it's just a validation of my own bias, where you actually sized up the market, properly, covered a wide range of providers, and you put the size of the market around, 100 million. So big kudos to you on that report. And I should say, this is not because you also identified Betterfolio as the fastest growing, discretionary MPS proposition in the land. And by the way, we didn't pay you for it. So this is the thing for me. It's like when somebody does independent work that anyone can buy, I can trust the work, or I tend to trust the work more. Anyway, so congrats on the report. Tell us a little bit about the key takeaways and findings.
Yeah, sure. I'm going to be like the guest on the Sunday morning show and say, can I just come back to something you said before, just about free reports? So I agree, nobody should give away free reports, but sometimes there's a topic that needs to be looked at by a research firm or by a consultancy independently that you just don't have the time to get funded, or you don't have the obvious sponsors. And so I think it's really important actually that financial advisors push consultancies to do some of that stuff, because it's really important for the overall good of the industry not to just do things that can be funded. So that's the only thing I'll say on that. In terms of the MPS report, thank you. So credit to Alex Johnson, our quant analyst, Hannah Weems, our client delivery manager, who worked really, really hard on this. We for a few years, this is the third year we've been doing this report. We only set up 4 years ago, so we're not going to have much more time to do anything. We've gone out to the market to try and get an estimate from the platforms on assets in discretionary model portfolios, and it varies hugely. So sometimes, if you ask one platform the share of flows going into discretionary MPS, they'll say 80%, but another one will be 20%. And
Right.
as everybody knows, different platforms support these things really differently. So getting to that number is really difficult. But we looked at asset growth. So there's some of the smaller, lower priced providers are growing the fastest. You'd expect, as a proportion of assets, those smaller providers have a better opportunity to grow faster because it's from a smaller base. But even when we look up the ranks, some of those larger providers who are lower priced are growing really rapidly. The other profile of firm growing rapidly is, of course, ones that have their own quote unquote distribution, so part of vertically integrated models. In terms of outlook for growth, we think it's going to continue. It's really interesting because we've just done a piece of that retirement advice research I mentioned for Aegon. So one of the things we consistently hear is half of advisors say that they would never use a discretionary portfolio manager or discretionary fund manager for model portfolios or bespoke for clients in retirement. And so we just asked a few more questions about it, and the report will be out in a few weeks. But essentially, it's advisors who don't use MPS or discretionary fund managers anywhere in their business. It's just not part of their model. It's not particularly a retirement issue. It is in some cases, but not particularly. But we think there's, with about half of advisors saying they're not using discretionary fund managers, there's a lot of opportunity for growth. And there's also a lot of discretionary bespoke that we think will continue to move over to models that are much more appropriate in terms of cost and outcomes for customers, for people, with up to £1 million in assets. Whereas a few years ago, the view would have been, it's good for people up to sort of 250,000, but that's really, really climbed. There's some really interesting things on pricing, some real clustering of pricing on the discretionary fee, the model portfolio fee. But when we look at OCF, it varies a lot more, as advisors really need to be looking at cost and the OCF, not just the MPS fee.
Now, a word from our sponsor. Nikki Heaton-Jones is the Managing Director and the Chief Investment Officer at Betafolio, the high-tech, low-cost, discretionary model portfolio manager. Typical model portfolio service costs about 36 basis points. That's in addition to the funds, the platform, the advice fees. Tell us a bit about Betafolio's view and approach on fees.
Well, I don't think anyone that knows us already, Abraham, would be surprised to hear me say that in a nutshell, MPS fees are too high. If you include the fund charges and the platform fee that you already talked about, we get close to 1%, I think, on average for a lot of retail clients. And that's before they start paying for the financial plan, which is the part of the service that will ultimately add the most value for them in their advisor relationship and experience. My view on fees and Betafolio's view on fees is that they have a real impact on client outcomes that needs attention. And that's why we're building a scalable solution with technology that will allow us to keep costs low. And I think we also should consider the impact of these fees on advisors' businesses too. Advisors need to make a profit from their work. They need to have a viable business, and their cost bases have been rising because of regulation, and the more cost they have to pass through to their clients for overcomplicated services in turn puts pressure on the advisor's own fees and ultimately makes it not possible for them to run a good business. So fees are really crucial, and I'm really happy that we're in a position to be having a positive influence on the trends in the market.
Good stuff. Thank you, Nikki. I agree with your point earlier about, well, if you look at the percentage growth, because the upstarts, this like us, are starting out with smaller assets. It makes sense that just in percentage terms, the growth has a much bigger impact. But even if you look at this in terms of amounts, so last year, Betafolio went from 100 million at the start of the year to 750, right? So that's like pulling, and if you exclude market growth, that's like pulling 600 million 600 million of assets just in a year. Now, if you compare that with, say, Tatton, for instance, Tatton would have pulled just over $1 billion in the year. I cannot think of any other MPS provider that's pulled that size of money. So you are right that there's gravitation towards the lower cost upstart, and we know that cost is driving this, and technology. The question in my mind, sorry, go on.
Well, I was just going to say, I mean, the growth for Betafolio at 703% year on year is phenomenal. And if you compare that to the next fastest growing, Saracen, with 199% growth, it's incredible. And Tatton's 42% is really, for a firm of that size, that's really big growth. But 703% is just, it's off the charts in terms of growth. So congratulations.
Well, thank you. Yeah, well, to me, technology is a game changer here. And I guess the question is, what are you seeing in terms of how MPS are using technology in their proposition?
So it's really interesting. We asked about this, and honestly, not much. There's some firms are offering a client portal where there's portfolio commentaries, and they'll be alerted if there's going to be a rebalance before it happens, so that if clients need to be taken out of you need to withdraw that cash before it gets swept up into the rebalance, you can do that. It's really not being done. And to me, the big gap is, I think, one that you're working on is, if you can, for particularly with clients' retirement, if you think about, I think it's 60% of advised assets are for retired clients. And so, and you'd expect that, because the need for financial planning increases as as the complexity grows and as you get closer to retirement. And so you'd expect the majority of assets to be in retirement. That's not a criticism of the advisor market, which some people seem to think it is, that they've got all old clients, not enough young. And I'm like, well, yeah, of course they do. But anyway, so if you have 60% of retirement, advised assets are for retirement clients, and you cannot combine the withdrawal strategy with the portfolio management strategy, it's bonkers. So no wonder advisors are saying, well, I'll just do it myself, because then I can figure out, I can withdraw from the things that have grown the fastest in the last quarter. I can sell those down to deliver income, rather than selling down across the portfolio and then rebalancing again. When the clients get their statements, they're like, what is going on? Why are there 50 transactions? And it gives a perception, true or not, because most DFMs would say it doesn't cost any more, and our analysis suggests that actually advisors using outsourced DFM are paying less for funds and portfolio management than they are if they're doing it themselves. But the perception is that it's costly, because customers recognize that when there's portfolio turnover, that's going to drive up trading costs, and it just seems inefficient and wrong. So it turns people off. So that gap in combining from a tech perspective, the withdrawal strategy with the portfolio management, to me, is going to be a big breakthrough for this market.
That's incredible, and that gives me a lot of comfort. I mean, it took us a while to figure this out. So I think the revelation, I think early last year for us, it was that, there is this thing called financial planning, right? So which we do with timeline, you do the risk profiling, all that stuff, cash flow, the accumulation strategy, you get all that nailed. And then, on the other side, you've got the investment or the engine that drives the plan. We know the platform, is just holding the investment. And to me, it's crazy that no one's managed to actually get the two talking to each other, in a way that we're doing with timeline and Bitfolio. So you got the plan, the goals, the aspirations. On one hand, doesn't talk to the money, and then you got the money who, and the money manager, in other words, the DFM, who has no idea what the money is for. So we'll see that how that evolves. I wanted to get your thoughts on the growth of MPS generally and how far you think this can go. So so this is the advisor platform market, say 600 billion market going to 1 trillion in 5 years time. And MPS is just what, according to your research, 100 million. Throw 20 million, either side of that. Actually, how, so that puts it at what? Puts it at 15% of the advice platform. How do you see this evolving? How far can this go? And how does it compete with the likes of, multi-asset fund or advised model portfolio, advised portfolios?
So it is a small percentage. As a percentage of the new assets, it's higher than 15%. I think one of the issues that we have as an industry that anybody listening will be well aware of is it's really hard to change the back book. First, from a client perspective, just you don't necessarily want to open up conversations with people to suggest that the portfolio strategy that you'd recommended in the past is somehow wrong, right? That creates that friction that can cause people to reevaluate the entire relationship. So you don't necessarily want to disrupt that. With new money coming in, it's higher than 15%. I'd have to look at our report to figure out what we'd said about it. But in terms of how far it can go, I think it really depends, because there are, if DFMs can combine that withdrawal strategy and some of the financial planning elements into portfolio management, I think there's really big opportunity for growth. As I said, I think there's a lot of money to move from bespoke discretionary into models. And in our interviews with DFMs, that was one of the things that they pointed to as one of the big drivers of growth, is that it's moving money across essentially within the business. And I think there's a lot more room there. But the potential is also that the tool sets get better for advisors to run model portfolios themselves, to ease some of the admin headaches and risk that happens around rebalancing, this idea of writing out to clients and portfolio drift that happens. It's possible that there's been a lot of work tried to be done to make that more automated, but it's not there yet. I think it'll also be really interesting what happens with the consumer duty assessment, or the new rules being proposed by the FCA to essentially build on from PROD rules. So if you have to assess the value to the client of the portfolio for an advisor, that's a huge piece of work to do that on an individual basis for clients, and so that might drive another lump towards outsourcing to discretionary fund managers who would do that. But equally, there might be a lot more transparency about the cost, and we might get a better sense of how DFMs can drive down cost, because if you're running a 2 or 3 person financial advice firm, you're not going to have much pricing power with fund managers, and DFMs, I think, need to be using that pricing power and that buying power to drive down costs. We're not seeing it enough. It's slightly lower. Advisors using DFM say that they're paying slightly lower for funds, but it should be a bigger difference because they're pooling that buying power. Now that only applies to active funds, though.
Yes,
so,
right.
but that's 70% of assets on platform.
Yeah.
It's still a huge proportion. So I think there's a lot of opportunity for growth, but there's other things that might make advisor models easier, or there's other things that might drive it further to out. Sorry, I went totally in circles there as
No, that's
usual.
brilliant. I like it. That's brilliant. I've already, again, your research, sort of puts the active funds in terms of OCF or the underlying fund, underlying OCF around 40 to 80 basis points, and I mean, you see some model portfolios on your chart at 1% and things like that. And I'm still wondering, I'm wondering how they get away with 80 basis points. you know so to me, it's like, what battle should you be fighting as a model portfolio provider? So for instance, our typical OCF is something in the region of 20 basis points, right? And then you layer 9 basis points to it. We could go out and indeed there's some work going on, and sort of create some sort of competition between BlackRock and Vanguard and Dimensional to get that cost to, say, 18 or 15 basis points, right? You could fight that battle. There's maybe 5 basis points of fat to remove. Or frankly, the debate from an advisor is paying 70, 80 basis points from an active for active management, in the sense that you could reduce the cost by 75% just from making that move. And so to me, it's like, what battle do you want to fight using the regulatory, using your scale as an MPS provider to knock off or shave off a few basis points, of the price, or actually the biggest impact comes from an advisor making the move from say expensive active portfolios to a lower cost one.
So I'm not an investment expert, so I'll leave the investment arguments to you, Abraham. But I think you've articulated, a compelling scenario there. I think, in terms of where to focus, what we hear from advisors is their main consideration. So there's been this big increase in use of multi-asset at the same time as we've seen this increase in MPS. And the driver for that is about reducing business risk and simplifying the advice process. And that's so important because advisors are constrained in their opportunity to grow and their opportunity to serve more clients. And so, it's really difficult to hire anybody at the moment. You can't hire financial planners, paraplanners. Their salaries have, my understanding is about doubled in the last year. It's very difficult to bring people into financial advice firms who are ready to do the job. And there's all sorts of great initiatives to try and train people up, but that's a future pipeline. It's not today. So you've got these constraints on advice businesses that advisors can deal with about 161 clients per advisor. And they're not saying that they want to deal with 500, because then it's hard to have those one-to-one relationships. But how can you spend more time on the things that matter most? And the things that matter most to the clients are not the portfolio management. And most clients don't care. They trust the advisor. We've done loads of focus groups over the last couple of years. One of the best things of lockdown is that the cost of doing a consumer focus group has dropped dramatically, because you don't have to hire one of those stupid rooms with the double glass. You just have it on Zoom and you can mute people if they start to dominate the conversation. It's brilliant as a market researcher. But when we talk to them about their choices for, investing in ESG funds, for example, or investing in passive versus active, or when we ask them about use of tools, they just say, I trust my advisor. If my advisor thinks it's the right thing to do, I trust them because they know me, they know what I'm trying to do. So, if I were you, and I think you are doing this, I'd be thinking about, how do I focus on what my advisors need to be able to grow their business, to reduce risk to the business, deliver better client outcomes, better client journeys, better client experience, to help them to then focus on the business of helping their clients plan so that they can grow their businesses in the way that they want and in the shape that they want. And so, whether it's shaving off 2 bits here or there, I don't think that's going to really move the dial. We've seen fantastic evidence that if people who see planners save much more for retirement, they suffer much less stress in terms of their financial sense of well-being. There's all sorts of good things that come out of financial planning. And so the more that providers can focus on helping to make the business of advice easier, the better, in my view.
That's a brilliant segue to my next question, in terms of what you see happening in the platform market. You have the likes of Circle, Fundmen, the new upstarts in that space, with perhaps slightly different business model than the established. So this idea of a small advisor firm, it goes white labeling is the wrong word, but this idea of them owning an operating platform because they are frustrated by the slow pace, I mean, if you can even call it that, of innovation, with platform. We don't have, for the vast majority of large platform, digital account opening process is still a problem. You and I disagree on the definition of digital signature, because I don't believe that just batching the same old form to clients just to get DocuSign on it, or printing the form and signing and scanning back is digital signature. But you seem to think so.
No, we don't. Scanned copy, we treat the same as a wet signature, because to us, they're the
Right.
same. We separate them out in our tables, but when we recognize digital process champions, it's that they require less than, I think it's 20% of forms require a scanned copy or a paper signature. But of course, the best way to go is to straight through processing. But no. Scanned copy is the same as a wet signature. I agree, 100%.
All right. Okay then. So in that regard, I mean, is this idea of advisors becoming platform managers and controlling it in some shape or form? Where do you see that going?
So, we did a report at the beginning of last year. Again, it was another free report because we tried to get sponsors and they all wanted to control what we were saying about them. So we're like, forget it, we'll just do it for free, because this is great. I mean, the control that these firms are trying to put in, and I agree, white labeling wasn't the right title. We used that because when we were talking to advisors, that's the terminology they were using. So we thought we'll just use the terminology of the customer, but it's probably wrong. We should have moved that on. But it's a free report on our website, Spectrum of White Label Platform. And there's all sorts of stuff in there about what it takes to run your own platform and the considerations to go through it, why people are doing it, what to consider. And 360 also did a really good paper on this topic. So I mean, I think it's really, really interesting what's happened. It's great that there's innovation. Are we going to see this, this stampede towards firms launching their own platform? We certainly seem to be seeing it. When we published our paper at the beginning of last year, half of firms with over 250 million or more in assets said that they were planning to launch their own platform in the next 3 years. And that's a huge number, right? It was pretty astonishing, but that's dropped off pretty significantly. It wasn't as big of a sample, so we didn't publish the figures, but it dropped down to about a third of firms in that category who were thinking about it. And it's not that those white labelers or the bespoke platform providers won't move their proposition on, but back to that question about what is it that you're doing as an advice firm, and what do you want to have ownership for? Do you really want to have CAS responsibilities? And I know that there's lots of great sales literature from those white label providers saying that you don't have to have the CAS responsibility. But if you look at the regulators' definition and look at what 360 published, if you tell your client it's your platform, you are responsible for that, and you cannot outsource that to the platform provider. So you have to be really aware of what it is you're doing it and why you're doing it. And the interesting thing is, I think there was a perception that firms were doing this to get a few bips. That was actually the last reason that came up in our conversations with firms. Right. It's about operational efficiency, the nightmare of the tech. The real problem, in my view, is the back office systems. And we see it in our data. When we survey advisors and we ask them about the tech they're using, platforms get pretty good reviews. Where there's a lot of frustration is the back office systems. And so, we're seeing all this innovation around platform because it's so hard to move the data And so are you really gonna do that? Are you gonna try a new back office system when you have to clean the data, invest a huge amount to get that ready, move it across, and it's not going to be perfect, let's be honest.
Yeah, and then
Nothing
move it
is.
across to where,
Yeah.
so that's no, really, really fascinating stuff. Look, Heather, there's a lot. I haven't even covered 2/3 of my questions with you, but I have to, for the sake of your time, and then of course our listeners getting bored of me yammering on. I have to try and wrap this up. So tell us a little bit where we can find you. You mentioned your advisor panel. Anything that comes to mind that you want our audience to know or to do?
Great. Well, you should definitely come see Abraham speak at NextWealth Live on the 22nd of March.
Wow.
Because we'll have another conversation about advisor tech. That's one thing, NextWealth Live, and then the research panel. We really want to hear from people working in financial advice businesses. So the NextWealth directory, or so the NextWealth panel. If you Google that, you can sign up, and then you get free access to all of our research. And if you're at work in a financial advice firm, and you can share your views so that we can aggregate those up and try and change the industry for good.
Heather Hopkins, thank you very much for your time and wisdom. Thank you for coming on the podcast.
Thank you, Abraham. It's a delight.
I'll be remiss if I don't thank my incredible team who worked very hard to put this program together. Thank you very much, guys. I'd like to thank our sponsors, Timeline App, the retirement planning software, and Batefolio, the high-tech, low-cost, flat-fee model portfolio manager. And to you, our listeners, thank you for your time. I hope you've had as much fun listening to the program as we have making it. You can find more about the show at retirementals.co.uk, and you can follow me on Twitter. My handle is Abraham on Money. Until next time, thank you and goodbye.